Hey guys, I am Zach Goldsmith, and this is my guy, Ben Bellick. Welcome to another episode of the Lender Lightning Round. Please don't do that.
I apologize.
Very excited today to welcome Super Lender, my guy for years. We've been working with, he's my go-to guy when I want to get a loan approved and when I want to get it across the finish line. There's no one I go to more. Trusted source. This is the purpose of today's episode.
What's his name?
I can't remember. I just call him. He's on speed dial. I call him Franchise. His name is Francesco Foggia. Ben's been calling him Francisco. He's one of the great lenders in the history of lending. There's never been a greater lender. Okay. And today's episode, we are going to grill him on all the questions you should be asking your lender when you want to buy a house. You probably are, and some you won't even know to ask. So with that, welcome to the show, my guy, Franchise.
Thank you guys very much. I appreciate the opportunity of being here.
We did a whole bunch of coke before this. Okay, let's just get right into it.
Yeah.
Your opinion only. Are interest rates going to go down this year? And we're not talking 10 basis points from week to week.
No, I mean, rates have been coming down since March, and the Fed is predicting a mild recession towards the end of this year, third and fourth quarter. So when that happens, I do think that rates are going to start dropping even more.
And does that mean a point?
Possibly, yeah.
Okay, so as much as you look a little nervous around a point.
I'm a little nervous around a point.
So like around a point?
Yeah, I think so.
So 5.5 lowest.
I mean,
we're not going to hold you to this.
Yeah, no, rates could go even further than 5.5. They can go into the 4s.
Oh, wow.
Yeah, I mean, for certain banks, they're hovering mid-5s right now.
Right, okay.
Yeah, so
in summary, and by the way, he's not an actor playing a lender. I know what they're thinking. They're
He is really
I'm not
good
trusting
looking.
this. He's a handsome fellow. So 2023 for you looks like rates on the downswing.
Yeah.
Later to say?
Yes,
Later.
third and fourth quarter. That's what they're predicting again. So I think that the year is only going to get better. There's still a lot of volatility in the market, but there's still limited supply and there's a steady demand. I think that for the real estate community, if you have any buyers that are sitting on the fence, they better step up and get into the game now, because when rates do come down, there's going to be a flood of buyers coming back into the market, and then you're going to end up sitting in the back of the line. So
okay, so even you think in recession, just because of low supply, and when rates go down, it will be competitive again and back to feeling like it was a few years ago.
Yeah, there's still a lot of people making a lot of money in this city, in Los Angeles.
Can you explain how the federal rate or the fund rate affects mortgage rates?
Yeah, well, the Fed funds rate is not directly tied to mortgages.
Yeah.
Okay, so the Fed funds rate is the overnight rate that banks charge each other to lend and borrow money. So when you hear that the Fed dropped rates a quarter of a point, that does not mean that rates went down a quarter of a point. There's other factors in play, economic growth, inflation, geopolitical events. You have to take that all into consideration. But no, when the Fed says we dropped rates a quarter of a point, that does not mean rates went down a quarter of a point.
Yeah, that's what baffles me sometimes.
Yeah.
And I try, people are so quick to jump on calling their clients, hey, rates went down, and their clients outsmart them. No, they didn't. And it's directly affected to the Fed, and there's so many moving parts. That's why we need you to kind of summarize it and figure this out for us.
Wait, but by the way, you did mention a quarter of a point, 25 basis points.
That was yesterday.
Okay, so
Wow.
Is there
check your day, boy?
Is there a number where okay, once we hit this number of the Fed fund rate moving up or down, that mortgage is affected, or maybe below it doesn't change? Is 25 where it moves?
You know what?
Or a quarter of a point?
There's not a direct correlation, like I said.
But just generally?
Generally, I can't say that.
Oh, wow.
There's just too many factors in play.
Because I heard someone recently say, who I respect tremendously, who actually just walked by a few minutes ago, he said that usually once it's a 25 base point move or a quarter of a point that on the fund rate, we see mortgage move.
You want a better indication of where rates are going? You want to look at the 10-year Treasury.
Okay.
So the 10-year Treasury dropped since yesterday. Okay. And so that means rates probably ticked down today. So even though the Fed funds rate went up a quarter yesterday, mortgage rates tick down today.
Okay, so what you're saying is there's a direct relationship. If the 10-year Treasury goes down, then mortgage rates are likely
a better indication.
Better indicator.
Yeah.
Let me ask you this then, because there's so much volatility day to day. If you identify a property and you want to lock in a rate, Can that be adjusted over the course of your escrow as rates go up or down?
Yeah. So typically when you lock in a rate, you're basically tying up the money for the bank. Okay. It's like buying a stock. If rates tick down, there needs to be a big enough drop for the bank to say, okay, we get it. Rates have dropped. We're willing to renegotiate your rate. But you can't just sit there and say, oh, wait, rates went down an eighth. I want a lower rate.
Oh, wow.
It's like buying a stock.
They won't do it.
Most banks won't, from my experience. No, they want to see a big enough drop.
Yeah, I'm guessing because if it goes up, you're not like, well, I want this.
Yeah,
so there's a little bit of risk aversion there. Okay, so for the people that are watching that don't quite understand, what is the difference between getting a fully amortized, like a 30-year fix versus an interest-only loan?
Okay, a fully amortized loan is when you're paying principal and interest monthly. Okay, you're paying down the loan. Interest only is just interest only. An interest only loan, let's just say 6% on $1 million. That monthly payment is $5,000 a month. A fully amortized payment at 6% is $59.95. There's a difference of $9.95. So the individual that would do an interest only versus a fully amortized is typically someone that has at least 20 to 25% equity in their home, that has very strong income. People think, oh yeah, let me get the interest only loan, but banks don't just qualify you on that interest only payment. I know people say, hey, I'd like that interest-only loan, but they don't have the income. Remember that typically these interest-only loans are 10 years of interest-only. These are 30-year loans. That leaves you 20 years left to pay back that loan. So when you're qualifying for that loan, the bank has to say, well, okay, well, what if they only pay interest-only for the first 10 years? There's 20 years left for repayment. We need to qualify you on a 20-year repayment. And then secondly, the rate that they qualify is not the note rate that they're giving you. They need to take into consideration worst-case scenario, which is, okay, it's either a 5, 7, or 10-year fixed, which means after 5, 7, or 10 years, the loan goes from fixed to adjustable. We need to take into consideration worst case scenario, which is what if it adjusts? So instead of the note rate of 6%, they may qualify you at 7.5% on a 20-year repayment. So you better have strong income to qualify. Now, the kind of folks that will do that kind of loan that I've seen, because I deal with a lot of financial planners, is they'll say, okay, my client is 50 years old, has a ton of equity in their home, and has not saved enough money for retirement. So they'll say, you know what, maybe you want to refinance into an interest only since you have a ton of equity there. Take that difference and put it in different buckets for retirement, in tax advantage programs like IRAs, et cetera. So those are the kind of folks that I'm seeing now that are doing interest only that have not saved enough money, or business owners that say, you know what, I don't need to do a fully amortized loan. I can take that difference of $9.95, put it into my business, and generate more than that 6% that I'm paying on that loan.
This is what I love about Francesco. Like for me, I have... You don't have to wink afterwards. They get it. Okay. Such a fucking adult film star. Look at him.
My God.
Gorgeous fellow, right?
You, brother.
Ben keeps getting closer. What I love about what you bring to the table is you care about the long-term success of your clients, kind of like we do. And so I see you on so many occasions. Why I keep referring to you is because you advise people on these different programs, the different tracks based on their lives. Because I think to myself half the time, should I be amortizing this loan? Should it be interest only? Should I? And I think what you bring to the table is really helpful. What all lenders should do is really advising your clients for the long term based on their situations.
Zach, it's important that you ask the client, what's your time horizon in this property?
Exactly.
How long do you plan on keeping this loan for?
Yeah,
because the most people that their parents come from, it's like they get the advice from a different era and they're like 30 year. And like for me, I'm very payment centric. So I want to bring, and I know I can't deduct the principal on my taxes. Correct. So I want to have an interest only loan. I want to be as less tax exposed as I can be. And in a market like Los Angeles where it's very expensive, I want to have as much purchasing power as possible within the underwriting standards. And then I know I'm probably going to move in before this 7-year or 10-year interest only matures into this now 20-year or 23 period to pay off the rest of the loan.
The average homeowner refinances every 7 to 10 years. And for the agents out there that are building your book of business, you should stay in touch with your clients because the odds of them wanting to sell, you get a new car, after 3 to 4 years, you're bored of the car. You end up having a child, you end up getting divorced, getting married, whatever the life changes happen, you're going to end up wanting to move on up. Or as they start to retire, move on down.
So should we buy right now at 6 and change %?
Absolutely.
Or should we?
Absolutely.
Or should we?
Absolutely.
It's always
hold on.
This is if we went
But I
back
was
to
gonna
when
say-
if we went back to when my parents moved here at the end of the 70s and interest rates were at 19%.
Exactly.
No,
And
that's
you
not what
asked
I was gonna-
Francesco, absolutely.
No.
not what I was
Interest rates have averaged 6%.
You're just so positive and optimistic.
Interest rates
I
have
love it.
averaged
Yeah.
6% over the last 30 years. The national average is 6.125.
I know, but you maniacs, I didn't get the second part of the
Okay, go
question
ahead.
out. Or should I wait until the end of the year when it's lower?
And when everyone else is jumping into the game?
This is what he
maybe
said.
that transitional
Inventory is low enough now. Interest rates drop. Then you are
Then you're
shit
This
out
is
of
a
luck.
November buy. It's in that little transitional period.
No.
Because the
Get
inventory's
pre-approved
going
now.
up.
But on that line of thought,
Oh, I'm pre-approved, pal.
let's
Yeah.
say, okay, so you buy now at 6 1/4. At the end of the year, rates drop to 5 1/2. Is that the time to refinance?
What is the number?
Well, there's a saying 24-month break even. If the difference in monthly payment, when you divide the closing cost by the difference in monthly payment and the difference is 24 months or less, then it makes sense to refinance. That's what I've always been told. But, look, the difference between 6 1/4 and 4.75, you marry the home, you don't marry the rate. You marry the home, you don't marry the rate. Jump in the game now. And my concern is when rates start to come down, we're going to start seeing a flood of people get back into the game. There's a lot of people on the fence.
So there's a specific algorithm for when you should
It's not
drop.
an algorithm.
It's not an
It's
algorithm.
very simple.
I was going to say, I was going to turn it into something else. There's a simple
Let's ask AI.
mathematic. There's a simple mathematic answer to whether or not you should refi based on if it drops 1 point, 2 points.
That's what I was going to ask because
Right.
I heard a lender once say you should, because a lot of people are saying, a lot of real estate agents are saying what you're saying right now is you marry the house, date the rate.
Right.
And what the lender was saying to me was it doesn't really make sense unless there's a 2% move on the mortgage rate. Is that not true?
Well, for me, I asked the client, how long do you plan on being in this home for? Okay, if you plan on being in this home long term, then do the break even and say, does that make sense for you? So I always ask people, what's your time horizon in this property? Does it make sense to refinance? And if they say, well, look, rates have dropped enough where I plan on being in this home for at least 7 to 10 years. And if the break even is 24 months and you stand to save $150 a month, is that enough for you?
Sure. Doesn't move the needle.
And I'm not the kind of guy that's going to push someone to refinance just to save them just a little bit of money.
sure.
That's going to take them 3 to 4 years to break even.
Yeah,
So
it
it's
makes
not
sense.
it's not always necessarily the right move.
No,
Just because rates drop, you get super excited, and you have to pay fees on that also.
Right, exactly. So you do the break even of what are the closing costs, the difference in monthly payment, and then you do the break even. And if it makes sense, then you do it. And if it doesn't make sense for you personally, then you don't do it.
Understood.
What is an example of a rate drop? If we're at 6 1/4% right now, and people are waiting till it drops to 4 3/4, like that monthly payment obviously is the
Depends on the
difference in
loan amount, of
losing the
course.
property.
It depends on the loan amount. If it's at a $300,000 loan, you're going to stand to save whatever the amount is, $80. I don't know. It could be $20. I don't know.
like for
but
me-
if it's $1 million loan, there's a big enough difference.
Yes. Yeah. When I buy ultimately this year, I'm going to put 15% down. So any refi will probably be more meaningful than someone who has 20 or 25% equity or down payment, right? That did a recent buy. So it's definitely more meaningful for me. So there are ways that people can reduce their monthly payment in escrow. Let's talk about the two that we know about, and then maybe any others that you know. So one, of course, please define a buy down and what you think about them. Which and then the other thing is like a client loyalty buy down or a rate drop.
Right. So a buy down is when you pay a bank funds at closing. So you pay points. So you pay a certain percentage of the loan amount up front. And the bank, so let me just give you an example. The bank gives you a couple different options. They say to you, okay, we're offering you 6% today. But if you pay us half a point, which is basically on $1 million loan, that's $5,000, we're offering you 5.75%. So the question then is, what's the difference in monthly payment? So on 6% at 6% on $1 million, the payment's $59.95, and at 5.75, the payment is $58.35. That's a difference of $165 a month. The cost is $5,000. So you divide the $165 into the $5,000. That break even is 30 months. So you say to yourself, okay, after 30 months, I'm going to save $165 a month. How long am I going to keep this loan for? Am I going to keep it for 30 years? Well, a 30-year loan is 360 months minus the 30, which is your break even. That's 330 months of saving $165 a month. That's a $54,000 a month life savings. But most people aren't keeping these loans for 30 years. So again, it has to make sense. Should I buy down the rate? How long am I going to keep this loan for? Again,
I got a pro tip for realtors after you talk about client loyalty rate reductions.
So by
the way, that was like you were like a professor at MIT. On
I crunch
Coke.
numbers for
like
a daily.
I got
such a number cruncher. Listen, $416
Do you ever take background
is $5,000.
It's fantastic. You ever micro machines?
Listen, I have to be like that when I'm on the phone with people.
Oh my God. I'm going to have to replay this in half speed.
I just told him the Italians are the new Jews.
Here's what you do. You get the buy down rate. You got to lock it in at 5%. Say someone comes in with $150. What are you going to do with that money? Wait,
what? So funny.
I couldn't follow.
But
anyway,
also,
I'll go back.
You can get a.
You guys don't want me to do that over again and say
No. You can get a better rate also for if you like move your retirement over, right?
Yeah. If you have so when I'm taking an application, I always ask people, do you bank with us? And if not, are you willing to open up a relationship? And most times someone will say absolutely. And if they bring over, a sizable amount to a bank, they're willing to reduce the rate.
Yeah.
It's important. At the end of the day, banks want to reward individuals who establish a banking relationship with them. I was a broker for 15 years, and a lot of times clients would say, well, I'm willing to move money over to the bank. And as a broker, I had no ability to do so. So I wanted to move over to the bank because clients like yours and Zach's have the ability to move money to a bank, and I want to be able to give as much as I can to individuals.
Yeah. Any other way to, aside from buy down and from client loyalty, to to kind of buy your way more discount?
I mean, if a seller's willing to, do you want to get into?
Sure.
Okay, so, I mean, for instance, a seller says, look, Ben and Zach, I want $1.2 million for my home. And you say, okay, why don't we list it for 1.22? Let's take that difference of 20,000 and let's offer it as a reward to a seller to buy our home, and we'll offer that as either a closing cost credit or they can buy down the rate. But look, guys, I mean, with rates going down by the end of this year, there's all this talk of 2-1 buy downs. None of my clients are doing it because they're not going to keep the loan for extended period of time.
You know what? Okay, I want to just give a quick pro tip, Zach, before you give your question. So as a real estate agent, right, you have a lot of commission that's built into a deal for anything that you are buying. So as the bank will limit the amount of closing costs or limit the amount of credits from the seller, which your commission is in the eyes of the bank, to your closing costs, you can use a portion of your commission instead of making it taxable or having the brokerage taking money off the top, and use that to buy down the rate too, particularly if you're really stretching. So sadly, some of the banks will limit you to 2/8 or 3/8 or whatever it is on the buy down.
I am a guy who's got money to buy a house. Okay. I want to ask you, first of all, how much you should put down based on what you've got. That's A. B is I've got some money with Citibank, City National, Bank of America. Where do I go? How do I know? Do I go to that bank first? Do I go to a mortgage lender? Or a broker? How do I take advantage and get the best rate? How do I know what I'm doing?
It's a really good question. So look, as I had mentioned, I was a broker for 15 years. And as a broker, I didn't have as competitive of a rate as a bank would. And brokers are great. I love brokers and I love being a broker. In this day and age, the benefit of being a broker really is being able to offer you more creative financing than being able to go working directly with the bank. When you have a relationship with a bank, they're going to basically want to keep you as a customer. They don't want another bank in your ear. They want to get all your business. So when you're discussing which bank to go to, I would call all of them and see where the rates are. Now, when it comes to when you don't have a relationship with a bank and you're willing to take your money from one bank and bring it to another, that new bank may say, wow, thank you for bringing over X amount. We're going to give you this rate, which sometimes can be more than just your existing relationship rate with a B of A or whatever other bank that you have a relationship with. So
because they're trying to woo you over.
They're trying to woo you over. So they'll give you more of an incentive. But then those banks will say, we don't want you to leave us. We're willing to match that rate. So then the question is, who do you want to work with? Who do you do your daily checking with for your auto debit? What's going to be more convenient for you? But then you also have to take into consideration, what are their turn times? What are their guidelines? Can you even qualify?
Yes, that's the tough part.
Keep in mind that I've worked for some of these bigger banks that you've spoken about. And in this day and age, as an agent, you want to make sure that if you bring a deal to a lender, you're not going to have an issue at the 11th hour.
Yeah.
Okay. So for me, I work for PNC Bank. Can I say that on the show?
Of course.
No.
Okay, I work for PNC Bank. And out of all the banks that I was interviewed with, and I could have worked for any bank, believe me, PNC Bank had the most common sense underwriting where they'll look at a deal and say, okay, this makes sense. The rates are terrific. They have super high LTVs. I mean, they're a super
Loan
jumbo.
to value.
Loan to value, right? And in Los Angeles, it's all about jumbos. And so I needed to work for a bank that had an appetite for jumbos. And so at the end of the day, talk about service. You want to talk about turn times, and you want to make sure that, you're getting a good rate, but you want to make sure you can qualify. There's a lot of fear. Your clients that are buying, they have a lot of fear. They're not sure if they can qualify. So, sometimes agents will say, go with a broker because they have access to all the banks. But guess what happens? Yeah, they'll get pre-approved, and then they'll go to wire the funds into escrow. And then that bank will say, where are you going? Why are you wiring this money into escrow? Have you talked to us first? And then they're already in escrow, and they say, we want to switch banks. And you as the agent will say, no, don't switch banks, please. We don't want any kind of delays. And guess what? You hope that doesn't happen.
Yeah.
So I had to find the happy medium,
Sure.
and that's why I chose PNC.
Yeah.
If I want to buy an investment property, an income producing property, or a second home, a vacation home, how are those rates broken down? How do they change?
How are they different?
How are they different? Yeah.
How are they different?
So typically, let's just say a primary residence, the bank's quoting you 6%. What I've seen is the difference between a primary residence and a second home, it may be an eighth or a quarter percent difference.
That little?
That's it.
And this,
Okay.
when you say
That's
a
what I've
second
seen
home,
with
is that that's vacation home?
Wait, hold on.
home.
That's when you've seen in the last 12 months because everything's so
In
high?
general,
Oh,
no.
in general.
Yeah, because look, the risk of you defaulting on a second vacation home is less than an investment property. During 2008 and 2009, when the economy tanked, people walked away from their investment properties and the banks lost billions of dollars. Second in line were the vacation homes. And then obviously the primary, most people didn't walk away if they didn't have to. So it's a level of risk, and that's how these banks price it out.
So the delta is so much greater in the investment property than
Correct.
the vacation.
Not
and
only
the
with
primary.
rate, but with loan to value, you have to put down a lot more money.
Why? Isn't the investment property subsidized by tenants versus vacay?
You would think that, but no, banks have lost billions of dollars and they want more skin in the game with down payment on investment
down
properties,
payment.
and their rates are higher.
So how does the down payment differ from
at
primary
least
to
25.
It's at least
vacation to
25%.
investment?
It's at least
25 on
25 to 30%
For investment or
for
vacation?
investment properties.
Yeah.
Yeah. You can get away with 20% down on second homes. I own a few of them. And at the end of the day, I wanted to make sure that I was getting the best deal. And to buy a vacation home, most banks have a guideline that says you're going to spend at least 4 months out of the year there. Now, it does not need to be a concurrent 4 months. It needs to be throughout the year. So for instance, Palm Springs, and as you know, Miami. So I'm jumping around, but other than staying there with my friends and family, I do short-term rental.
So I have a question for you. This is maybe a little bit more predictive. So like when you look at the spread yield of all of the different loan products right now, it's pretty flat.
Yeah, it is.
So basically what I'm asking him is basically like if you look at the differences between a 30-year fix and these interest-only loans, usually the difference or the variance between them, the more risk you take on, the better of a rate they're willing to give you, because when those shorter interest-only loans mature, then the bank comes back and gets their risk they get their risk back. So do you think that right now that yield curve is so flat because of this kind of contagion of sorts that we're seeing with the regional size banks? And do you think at some point, because right now an interest only loan is about the same as a 30-year fix?
It's off by.
They're pretty close.
Yeah, they're pretty close. Yeah, I would say about 0.25% difference. I think that we're not in a normal interest rate environment right now, and I think ultimately it's going to get back to that, and so you're going to start to see a wider spread between the ARMs and the 30-year fix. I mean, look, when banks know that they're going to get paid back in 5, 7, or 10 years, they'll give you a better deal. They want their money back. They want to redeploy that money. If they know that you're going to lock up their money for 30 years, well, then, at the end of the day, they want to get paid a higher premium for that loan, a higher premium, a higher rate for that loan.
And do you mention that you have some investment properties? Do you find that we're in an environment now where, because I own a home in the desert, where I maybe pull money out of this house to get the next thing? Or is that the over leverage nightmare?
You know what? Back in 2008, 2009, a lot of people lost their shirts because they over leveraged those homes and banks were just giving away money.
Oh, okay.
And then they lost it all. Nowadays, banks will not allow you to super leverage your homes. But yes, if you have the income to borrow that money, take that money and go buy other assets that you can generate income off of, hard assets that you can depreciate, and of course consult your CPA and all that.
Sure.
But there are advantages to owning second homes. Financing them as second homes versus investment properties. But of course, you have to spend time there. Look, I'll leave you with this. I don't want to look at a piece of paper and says, oh, I have money. I want to enjoy my money. I want to swim in that pool. I want to share it with my friends and family. So that's why I buy real estate. And second homes obviously have better financing than an investment property. I have a friend of mine that owns a investment property in Northridge, and I asked her, I said, how's it going? She's like, I get a check every month. And, she knows I have a house in Palm Springs. She's like, I wish I would have bought in Palm Springs where I can actually enjoy my money versus just an investment property. So when you're talking to your clients, ask them, hey, are you interested in buying a second home? Let's talk to a lender about a vacation property and look at their guidelines and see if they'll allow you to finance it as a second home and also do short-term rental.
So break down in 20 seconds a primary, an investment, and a vacation home, what the difference you have to come down with.
I mean, you can get, on a primary residence, it depends on the purchase price, of course, but there are banks doing 90% financing right now.
So 10% down on a primary,
or
and
even
some
less.
banks.
It depends on look, you can get away with putting 3% down, but,
Not
typically,
no,
not a jumbo.
What's the cutoff right now?
726 and some change.
Then you have to pay mortgage insurance on that
if you put down less than 20%.
Yeah.
But there are some lenders that will build that into the rate. But look, there's conforming loans, 726 and some change, and then there's high balance conforming loans, which is $1,089,000 and some change. And look, for me, if the loan amount is above $726,000, I can price that as a jumbo loan, giving you jumbo rates, which have a lower default rate. So, it all depends on the loan amount. Yes.
Okay, let's say $1 million loan.
Going back to your question.
Yeah, let's say $1 million. I want to buy $1 million. Let's go to Northridge. I want to buy a fourplex in Northridge as an investment property. What am I putting down on $1 million fourplex?
He means 5.
You can get away with 95% financing or even 96.5 with an FHA.
For an income producing property?
Yeah, but go to 5 units. It's different
5 units
than 4.
is a different animal.
That's
so
what I
residential
mean.
is 1 to 4 units.
Well, 1 to 4 is a different
But 5
story.
and above, that's a different animal.
Yeah.
I don't do,
Yeah.
that's commercial
Okay,
financing.
fine.
And a lot of times they'll look at the actual cash flow, the cap rate
Sure.
on those
Yeah,
properties.
what's the income?
And that income is what will determine what your loan amount is. If it has great income, the bank says, oh, you have great income here. It's a great business. We'll give you more money. If it doesn't have the cash flow, then the bank says, no.
Sure.
You need to come up with more skin in the
It's the
game.
straight risk.
Yeah.
And then I want to buy a vacation property in Palm Springs for $1 million. What do I put
20% down.
Can't get away with 10.
Maybe some lenders will do, no, not 10. I don't know. Maybe, but not with me. I don't think with
20% down.
I did 20 on mine.
Yeah,
And it
20.
closed in December of 2021, I think. I did 20.
let me
but they
check.
offered me 15. But anyway, that was also a different time.
Yeah, it's a different time.
Do you have any other questions? That was information packed.
Yeah, that was a lot of information. We're going to have to slow that down to half speed. But we are going to post this again because
What do you mean we're going to post this? We post all of our episodes.
I mean, I always want to post things afterwards, like post a breakdown of these things. I want him to write, summary of things. We got to summarize this.
Guys, thank you for tuning in to an information-packed episode of To Live and Buy in Los Angeles. We did cover a lot very quickly. We encourage you to go back and listen again. There were a lot of pro tips in there for those of you that are looking to buy a primary residence that is below or above the conforming rate, also vacation homes and investments. And if you have any other questions, be sure to post them, and then we can forward them on to the franchise.
You just reach out to me and I will put you in
Foggia.
touch with the franchise directly.
Reach out to Zach. Guys, thank you again. I'm at Ben Bellack. This is at Zach Goldsmith 24. And where can they find you?
At Francesco 769.
There you go.
We'll delete that part out. But it was great having you. Very information packed. You didn't want a lender on. I told you he was exciting and full of info. We greatly appreciate your time. We're out.
Super bien.
Oh, he took it now. Goodbye, everyone.